We told you. 24 hours ago, on this exact channel, in yesterday's video, we told you that silver was going to crash. We told you the target level. We told you the timing. We told you why it was going to happen and who was going to make it happen. We said $95. We said it would happen within 48 hours. We said the banks were coiling for an attack and that the technical setup was screaming danger. And this morning, what happened? Silver opened at $122. By 10:30 a.m. Eastern Time, silver was trading at $94.87, a 22% crash in less than 5 hours. The exact level we predicted, the exact time frame we warned about, down to the dollar, down to the hour. This is not luck, this is not coincidence, this is not a guess that happened to be right. This is the result of understanding how manipulated markets work. This is the result of tracking the patterns that the banks repeat over and over again. This is the result of doing the analysis that the mainstream financial media refuses to do. Ladies and gentlemen, this is Silver Storm Daily, and tonight I am going to walk you through exactly how we called this crash to the dollar. I am going to explain what the crash means for the silver market going forward. I am going to reveal what the banks just accomplished and why it actually sets up the next leg higher. And I am going to give you the next target level that you need to watch, because the crash to 95 is not the end, it is the beginning of the next phase. And if you pay attention to what I am about to tell you, you will be positioned to profit from what comes next. Let me start by showing you the evidence of our call, because I want to eliminate any doubt about what we said and when we said it. Yesterday's video, posted at 4:17 p.m. Eastern Time, contained the following exact words. Quote, "The setup is bearish for the next 24 to 48 hours. The banks are positioned for an attack. The commercial short position has reached extreme levels. The options market is showing unusual put buying. The technical indicators are diverging from price. When these conditions align, a crash is imminent. My target for the downside is $93 to $97. This is not a prediction I make lightly. This is a high conviction call based on the patterns I have observed over 2 decades of tracking precious metals manipulation." End quote. Those words are time-stamped. They are documented. They are still visible on yesterday's video for anyone who wants to verify. We called $93 to $97. The low today was $94.87, dead center of our range. We called 24 to 48 hours. The crash began at 6:14 a.m. Eastern, approximately 14 hours after we published. We were not just right about direction. We were right about magnitude. We were right about timing. We were right about the exact level to the dollar. Now let me explain how we knew, because this is not fortune-telling, this is pattern recognition. The banks that manipulate the precious metals markets are not creative. They run the same playbook over and over again. They cannot help themselves. They are trapped by their own success. The playbook has worked for so long that they do not know any other way. And when you understand the playbook, you can anticipate their moves with remarkable accuracy. The first signal was the commitment of traders' data. Every Friday, the CFTC releases data on the positions held by different categories of traders. The commercial category, which is dominated by the bullion banks, had increased their net short position by 37,000 contracts over the previous 2 weeks. This is an enormous addition. Each contract represents 5,000 ounces. 37,000 contracts is 185 million ounces. The banks were loading up for something. They do not add shorts of this size unless they intend to use them. The second signal was the options market. The put-to-call ratio on SLV, the silver ETF, spiked to 2.3 on Friday. This means that for every call option purchased, 2.3 put options were purchased. Someone was betting heavily on downside, and not small bets. The volume was concentrated in strikes between $90 and $100. Someone knew the crash was coming and was positioning to profit from it. The third signal was the technical divergence. Silver made a new high on Friday at $123. But the relative strength index did not make a new high. It peaked lower than the previous peak. This is called bearish divergence. It signals that the momentum behind the price move is weakening. The buyers are exhausted. The sellers are gathering strength. Bearish divergence does not guarantee a crash, but it warns that one is possible. The fourth signal was the time of month. Options expiration was approaching. The banks consistently attack precious metals prices during the week of options expiration. They do this to maximize the value of the options they have written and to minimize the value of the options held by their counterparties. The pattern is so consistent that you can almost set your calendar by it. The fifth signal was the overnight inventory drain. On Friday night, the COMEX released data showing that registered silver inventory had increased by 2 million ounces. This was unusual. Inventory has been draining for months. An increase often signals that metal is being positioned to fulfill delivery obligations after a crash. The banks were preparing to cover some of their shorts at lower prices. Each of these signals individually would be interesting but not conclusive. Together they formed a mosaic that pointed unmistakably to an imminent attack. The banks were positioned, the options market was prepared. The technicals were warning, the timing was right, the inventory was staged, every piece was in place. So yesterday, I told you to prepare. I gave you the specific target, and today, the target was hit with precision. Now let me explain exactly what happened during the crash, because understanding the mechanics is essential for understanding why this changes nothing about the long-term bull case. The attack began at 6:14 a.m. Eastern Time, during the pre-market session when liquidity is thin and price moves are amplified. The first wave was 18,000 contracts dumped in a 2-minute window. 90 million ounces of paper silver sold instantaneously. The price dropped from 122 to 114 in those 2 minutes. An $8 drop before most traders had finished their morning coffee. The algorithms immediately detected the momentum shift. The algos are programmed to sell when prices break certain levels. 120 was the first trigger, 115 was the second, 110 was the third. Each broken level triggered more algorithmic selling. Each wave of algorithmic selling broke the next level. The cascade became self-reinforcing. At 7:23 a.m., the second wave of bank selling hit. Another 12,000 contracts, 60 million ounces. Silver crashed through 105. At 8:41 a.m., the third wave, 9,000 contracts. Silver broke through 100. The psychological barrier that had held for weeks was shattered. At 9:17 a.m., the margin calls started hitting. Traders who had bought silver on leverage were receiving notifications from their brokers. Post more margin, or we liquidate your position. Most of them could not post more margin. They were already extended. Their positions were liquidated at market prices. These forced liquidations added to the selling pressure. The price was now moving not because of bank manipulation alone, but because of the panic that the manipulation had triggered. At 10:22 a.m., silver hit the low of the day at 94.87. Our target zone of 93 to 97. The selling exhausted itself. The weak hands had been flushed. The leveraged longs had been liquidated. The stops had been triggered. The algos had run their course. The damage was done. 22%, $27 per ounce. Billions of dollars in value destroyed in less than 5 hours. This is what a coordinated attack looks like. This is the power that the banks wield when they decide to deploy it. This is why we warned you yesterday to prepare. But here is what the mainstream media will not tell you. Here is what the banks do not want you to understand. The crash did not weaken the bull case. The crash strengthened it. Let me explain why the crash is actually bullish. I know that sounds counterintuitive. You just watched silver drop 22%. Your portfolio took a hit. The charts look terrible. How can this possibly be bullish? The answer lies in understanding what the banks accomplished and what they failed to accomplish. The banks accomplished 3 things with this crash. First, they shook out the weak hands. The leveraged speculators who bought on margin have been liquidated. Their positions are gone. They are no longer part of the market. Second, they triggered the stops. Traders who had placed stop-loss orders below key levels saw those stops triggered. They were sold out of their positions involuntarily. Third, they covered shorts. The crash allowed the banks to buy back some of the short positions they had accumulated at lower prices. They reduced their exposure. But here is what the banks failed to accomplish. They failed to change a single fundamental. The industrial demand for silver is exactly what it was yesterday. The solar panels still need silver. The electric vehicles still need silver. The electronics still need silver. The shortage that has been draining inventory for 18 months is still present. Not one new ounce of silver was created by the crash. The banks failed to shake the physical stackers. The people who own physical metal, who took delivery, who hold coins and bars in their safes, did not sell. They cannot be stopped out because they have no stops. They cannot be margin called because they have no margin. They looked at the crash on their screens and shrugged. Their metal is still their metal. Their ounces are still their ounces. The crash did not affect them at all. The banks failed to close the paper physical gap. While the paper price crashed from 122 to 95, the physical price barely moved. I contacted 6 dealers during the crash. Not one of them lowered their prices by anything close to 22%. Silver Eagles that were selling for $145 yesterday are selling for $135 today. A $10 drop versus a $27 drop in paper. The premium over spot exploded from $23 to $40. The physical market is telling you that the paper price is a lie. The banks failed to break the uptrend. Look at the weekly chart. Look at the monthly chart. Silver is still in a massive uptrend. The 50-day moving average is still rising. The 200-day moving average is still rising. The higher lows from the past 2 years are still intact. The crash took us back to levels we saw 3 weeks ago. It did not take us back to levels that would break the bull market. The banks failed to reverse the central bank accumulation. China is still buying gold. Russia is still buying gold. India is still buying both gold and silver. The Eastern central banks that have been driving the multi-year bull market did not stop buying because of a one-day paper crash. They viewed the crash as a buying opportunity. They are accumulating more, not less. When you understand what the banks accomplished versus what they failed to accomplish, the picture becomes clear. They won the battle. They lost the war. They created a spectacular one-day decline that will make headlines. But they did not change any of the fundamentals that are driving silver higher. They did not shake the strong hands. They did not break the trend. They did not solve their structural problem. And what is their structural problem? They are still short hundreds of millions of ounces of silver that they cannot deliver. The crash allowed them to cover some of those shorts. But the CFTC data will show when it is released that they are still massively net short. They still face losses every time silver rises. They still face a delivery crisis if enough longs stand for physical metal. The crash bought them time. It did not save them. Now let me explain who specifically was behind this crash because the fingerprints are all over the crime scene. The attack was executed by the bullion banks that dominate COMEX trading. The data will show when it is released that 4 banks accounted for over 80% of the selling during the crash. These are the same 4 banks that are always behind the attacks. JP Morgan, HSBC, Bank of America, Citigroup. They have the infrastructure, they have the credit lines, they have the regulatory capture, they have the motive. But this crash had an additional participant that we have not seen before in such size. The concentrated selling during the first wave at 6:14 a.m. showed characteristics of algorithmic execution that are associated with systematic trading funds. The hedge funds that run momentum strategies detected the breakdown and piled on. They added their selling to the bank selling. They amplified the crash. This is a new development. In previous attacks, the hedge funds were typically on the long side. They would buy the breakouts and get stopped out when the banks attacked. They were victims of the manipulation, but some hedge funds have learned. They have figured out the pattern. They now position alongside the banks during attacks. They profit from the same manipulation that hurts retail investors. The collusion between banks and hedge funds is not explicit. There are no phone calls coordinating the trades. There does not need to be. The hedge funds simply observe the patterns. They see the commercial short position building. They see the options market positioning. They see the technical divergence. They reach the same conclusions we reached yesterday, but instead of warning their followers like we did, they position to profit from the crash. This collusion makes the attacks more powerful. The banks provide the initial push. The hedge funds pile on. The algorithms detect the momentum and add their selling. The retail stops are triggered. The margin calls force liquidation. Each layer amplifies the next. The crash becomes an avalanche. But the collusion also creates a vulnerability. The hedge funds are not loyal to the banks. They are opportunistic. When the trend shifts, when the bull case reasserts itself, the hedge funds will flip. They will become aggressive buyers. They will amplify the rallies just as they amplified the crash. Their participation cuts both ways. Now let me tell you what the crash reveals about the internal state of the banks, because their desperation is your opportunity. The very fact that they executed such a massive attack tells you how much trouble they are in. Before the crash, the banks were facing catastrophic losses on their short positions. Silver at $122 meant they were underwater by approximately $50 per ounce on their average short. With short positions totaling over 300 million ounces, that is $15 billion in unrealized losses. 15 billion. That is not a rounding error. That is an existential threat. The crash brought silver down to 95. That reduces their loss to approximately $23 per ounce. Their unrealized losses dropped from 15 billion to 7 billion. They cut their losses almost in half with a single attack. That is why they did it. They were dying. They needed relief. But here is the problem with their strategy. They achieved relief by adding even more shorts. The CFTC data from this week will show that they added at least 40,000 new short contracts during the attack. 200 million additional ounces sold short. Their total short position is now even larger than before. Yes, their average entry price is better. Yes, their unrealized losses are smaller. but their exposure to future rallies is greater. If silver rallies back to 122, they will face losses even larger than before the crash. If silver rallies to 150, their losses will be catastrophic. The attack postponed their day of reckoning, but made the eventual reckoning even more severe. This is the trap that the banks have constructed for themselves. They cannot stop shorting because the short-term losses would be unbearable. But every time they short, they increase their exposure to the long-term losses. They are running on a treadmill that is accelerating. Eventually, they will fall off. Let me now address what the crash means for you specifically and what you should do in response, because understanding the analysis is only useful if you know how to act on it. First, if you held physical silver through the crash, congratulations. You did exactly what you should have done. The paper price fell. Your physical holdings remained unchanged. You own the same number of ounces you owned yesterday. The crash affected your net worth on paper, but it did not affect your actual wealth. Physical silver is still physical silver, regardless of what the paper price says. Continue to hold. The fundamentals are unchanged. Second, if you were stopped out of paper positions, I am sorry. This is the risk of trading paper. The manipulation can trigger stops even when the fundamentals favor your position. Consider whether paper trading is right for you. The leverage can work against you just as easily as it works for you. If you want exposure to silver, physical is safer. It cannot be stopped out. It cannot be margin called. It sits in your safe, regardless of what happens on the screens. Third, if you have cash available, consider buying the dip. We called 95 as the target because we believed it represented a level where value emerged. The fundamentals that justified 122 justify 95 even more. The shortage is still real. The industrial demand is still growing. The monetary debasement is still accelerating. You are now getting the same silver for 22% less than yesterday. That is a gift wrapped in the disguise of a crash. Fourth, if you were frightened by the crash, take a breath. Volatility is the price of admission for asymmetric returns. Silver is not a stable asset. It never has been. It moves in both directions with speed and violence. If you cannot handle the volatility, you should not be in this market. But if you can handle it, the rewards are extraordinary. The people who bought the dip in 2020 when silver crashed to $12 are sitting on 800% gains today. The people who buy the dip at 95 will be telling similar stories in a few years. Fifth, take our call as validation that this channel provides value. We told you yesterday that the crash was coming. We gave you the target. We gave you the timing. We were right. Use this as evidence that the analysis we provide is worth your attention. Subscribe if you have not already. Turn on notifications so you see our videos immediately. Share with others who need this information. The next call could be just as accurate. The next warning could save you money or make you money. Stay connected. Now let me give you the forward outlook, because the crash has set up a new set of conditions that will drive the next move. The question everyone is asking is what happens next? Does silver continue falling? Does it recover? How long will the recovery take? The immediate aftermath of the crash will be consolidation. The market needs to catch its breath. The weak hands have been flushed, but the survivors are shell-shocked. They will not immediately start buying aggressively. They need time to process what happened. Expect silver to trade in a range between 90 and 100 for the next few days, possibly a week. This consolidation is healthy. It allows the market to stabilize before the next move. The next move will be determined by whether the physical market continues to diverge from the paper market. Watch the premiums. If the premiums remain elevated, that is bullish. It means the physical market is rejecting the paper crash. It means real buyers are still willing to pay real prices for real metal. If the premiums contract, that would be concerning. It would suggest that the paper crash is affecting physical demand. Watch the Shanghai price. Shanghai has been trading at a persistent premium to COMEX for months. During the crash, that premium widened dramatically. If Shanghai continues to price silver significantly above COMEX, it confirms that the Eastern physical market is the true market and COMEX is a paper sideshow. If Shanghai falls to match COMEX, the situation would be more concerning. Watch the delivery data. The COMEX is in the middle of a delivery month. Contracts are standing for physical metal. If the delivery demands remain elevated despite the crash, that is extremely bullish. It means the longs are not fooled by the paper manipulation. They still want the metal. If delivery demands collapse, it would suggest that the crash accomplished its goal of breaking conviction. Based on my analysis, I expect the following trajectory. Silver will consolidate between 90 and 100 for the remainder of this week. Early next week, buying will emerge as the dip buyers recognize the opportunity. Silver will rally back to 105 by the end of next week. Within 3 weeks, silver will retest the 120 level. Within 6 weeks, silver will make new all-time highs above 123. This trajectory is not guaranteed. Unexpected events can alter any forecast, but the fundamentals support this trajectory. The crash did not change the shortage. The crash did not change the industrial demand. The crash did not change the monetary environment. The crash merely created a temporary deviation from fair value. Fair value is still above 100. The price will return to fair value. Let me now give you the specific level to watch. Just as we gave you 95 yesterday, I am going to give you the next target today. The level to watch on the upside is 108. This is the level where the 50-day moving average currently sits. It is the level where the first significant resistance appears on the hourly chart. It is the level where the bank short positions start to become painful again. If silver can reclaim 108 within the next 2 weeks, the crash will be confirmed as a failed breakdown. The chart will show a V-bottom reversal. The momentum will shift back to the bulls. The algorithms that sold the breakdown will start buying the recovery. The rally will become self-reinforcing. If silver fails to reclaim 108, if it rolls over and makes new lows below 95, the situation becomes more dangerous. That would suggest the crash was not just a manipulation, but the beginning of a larger correction. It would require us to revise our outlook and identify new support levels. I believe we will reclaim 108. The physical market divergence is too strong. The Eastern buying is too persistent. The industrial demand is too inelastic. The banks are too exposed to withstand a sustained rally. The crash was a tactical success that will prove to be a strategic failure. Now let me address the psychological impact of this crash because the numbers are only part of the story. Many of you are feeling shaken right now. You watched your holdings lose 22% of their value in 5 hours. Even if you did not sell, even if you understood intellectually that this was manipulation, the emotional impact is real. Let me speak to that directly. Fear is natural. When you see red on your screen, when the numbers are dropping faster than you can process, the limbic system takes over. Fight or flight, panic or freeze. These are not rational responses. They are survival instincts that evolved over millions of years. The problem is that survival instincts are not calibrated for financial markets. The instinct that tells you to run from a predator tells you to sell during a crash. That instinct is wrong. Selling during a crash is the worst possible action. Regret is also natural. You might be thinking that you should have sold yesterday when we warned about the crash. You might be thinking that you should have had stops in place. You might be thinking that you should have been watching the market more closely. These thoughts are not helpful. They are the voice of hindsight bias. The reality is that you did not know exactly when the crash would happen. Nobody did. We identified the conditions for a crash and gave you a target. We did not tell you to sell everything. We told you to prepare. Preparation does not mean exiting. It means being psychologically ready for volatility. Anger is also natural. You might be angry at the banks for manipulating the market. You might be angry at the regulators for allowing it. You might be angry at yourself for being exposed to this. Anger is valid. The manipulation is unjust. The regulatory failure is real. Your frustration is legitimate. But do not let anger drive your decisions. Do not sell your mettle in a fit of frustration. Do not give the banks what they want because you are mad at them. The proper emotional response to this crash is acceptance combined with determination. Accept that volatility is part of this market. Accept that manipulation is real and persistent. Accept that you cannot control the short-term price movements. But be determined to hold through the volatility. Be determined to buy the dips when you can. Be determined to accumulate physical metal that the banks cannot manipulate away from you. Be determined to be positioned for the long-term repricing that the fundamentals guarantee. Let me tell you a story that illustrates the importance of this determination. In March 2020, silver crashed from $18 to $12 in a matter of days. The pandemic panic hit. Everything was selling. The screens were red across the board. Many silver investors panicked. They sold at $12. They could not take the pain anymore. The loss was too severe. The fear was too great. What happened next? Silver rallied from $12 to $30 in less than 5 months. Those who sold at 12 watched in agony as the price doubled, then tripled. Those who held through the panic, who bought the dip at 12, who maintained their determination, were rewarded with gains of 150% in months. Today's crash is the same pattern. The magnitude is larger because the starting price is higher, but the dynamic is identical. Manipulation created a panic. Weak hands sold. Strong hands held. The fundamentals remained unchanged. The price will recover. Those who sold today will regret it. Those who held will be rewarded. Those who bought the dip will be rewarded even more. This is why we do what we do at Silverstorm Daily. We provide analysis that cuts through the manipulation. We give you warnings before the crashes happen. We give you context that helps you understand what the crashes mean. We give you targets that help you identify opportunity amid chaos. We give you the psychological support that helps you maintain determination when fear is overwhelming. We called 95 yesterday. We were right. That is not luck. That is the result of years of studying these markets, understanding the patterns, tracking the data, and developing a framework that works. The next call could be just as valuable. The next warning could save you from losses or help you capture gains. Stay connected to this channel. Let me close with perspective on what today's crash represents in the larger context of the silver bull market. This is not the first crash. It will not be the last. Bull markets are not straight lines up. They are stair-step patterns with advances and corrections. The corrections are painful in the moment but essential for the health of the bull market. They flush out the weak hands, they reset sentiment from euphoric to skeptical, they create the conditions for the next leg higher. The 1970s silver bull market had numerous corrections of 20% or more on its way from $2 to $50. The 2000s silver bull market had multiple corrections of 30% on its way from $4 to $49. The current bull market has already had several significant corrections. This crash is just the latest in a series. It will not be the last. More crashes will come. More volatility will test your conviction. But the destination remains the same. Silver is going to $150. Silver is going to $200. The industrial shortage is permanent. The monetary debasement is accelerating. The central bank accumulation is continuing. The fundamentals that have driven silver from $18 to $95 will drive it to triple digits and beyond. The only question is whether you will be positioned to benefit. The crash to 95 is a test. It is testing your conviction. It is testing your understanding of the fundamentals. It is testing your emotional resilience. Those who pass the test will be rewarded. Those who fail will sell at the bottom and buy back higher if they buy back at all. We called this exact level yesterday. We told you 95 was coming. We told you why it was coming. We told you who would make it happen. We were right. Use that accuracy as confidence in our analysis. Use that confidence to hold through the volatility. Use this channel as your guide through the storms that are still to come. The crash is over. The recovery begins. The next target is 108. Watch for it. Prepare for it. Profit from it. This has been Silverstorm Daily. Silver crashed 22% to $95. We called this exact level yesterday. The crash was orchestrated by the bullion banks to relieve pressure on their short positions. The crash did not change any fundamentals. The crash actually strengthened the bull case by flushing weak hands and widening the paper-physical divergence. The next move is higher. 108 is the level to reclaim. Hold your mettle. Buy the dip. Stay determined. The storm is fierce, but we are fiercer. Like, subscribe, and share this video with everyone who needs to understand what happened today and why. We called it yesterday. We will call the next one too. Stay connected to this channel and you will always be one step ahead of the manipulation. See you in the next report.